Most indicators do not fail because they are bad tools. They fail because each one only solves one thing. RSI tells you if the market is overbought or oversold, but it cannot tell you if the trend is intact. MACD shows a momentum shift, but it tends to lag and read messy in the middle of a real move. So you add another indicator to fill the gap, and another one after that, and the chart becomes cluttered, and eventually the signals contradict each other. What if I say there is a better way to do this? In this video, I am going to show you exactly what that looks like. There is free indicator, already on TradingView, no paid account required. That handles all of it. Trend identification, asset selection, entry timing, stop-loss placement, every part of the process, covered by one tool. Stay until the end, because the entry and exit logic is the most important part, and it comes later. The indicator is the exponential moving average, specifically three of them: the 11 EMA, the 21 EMA, and the 51 EMA. Let me explain what a moving average actually is before anything else, because understanding the mechanics changes how you read it. A moving average is the average price of an asset over a fixed number of candles. It is called a moving average because it continuously updates. Every new candle adds the latest price and removes the oldest one from the calculation. So a 21 EMA is always reflecting the average of the last 21 periods, shifting forward as price moves. The reason this uses exponential rather than simple is the weighting. A simple moving average treats every period in the look-back equally. The exponential version gives more weight to recent prices. That makes it faster. It picks up momentum changes earlier and reacts more quickly to what price is actually doing right now. For swing trading crypto, that responsiveness matters. EMA is the right choice here. Now, why 3 EMAs instead of 1? Because each line is doing a separate job. On the chart, the 11 EMA appears as a blue line. That is your short-term trend level. When a coin is in a clean high momentum move, price tends to stay close to this line and respect it on pullbacks. The 21 EMA is the white line. That is your medium-term trend level. It gives the asset a little more room and still holds during most healthy trends. And the red line is the 51 EMA. Think of this one as the floor. Nothing good happens below it. If price drops under the 51 EMA, the trend structure is compromised and you do not want to be in a swing position below that line. So the visual setup is simple. Blue is 11, white is 21, red is 51. The first use case is trend identification. This sounds obvious, but the way most people read it is wrong. The condition for a confirmed uptrend is specific. Price must be above all 3 EMAs. The 11 must be above the 21 must be above the 51, and all 3 lines must be sloping upward together. When all 4 of those conditions are met at the same time, the trend is intact. That is the environment you want to be trading in. Now, if price dips briefly below the 11 but the 21 and 51 are still aligned and rising, the trend has not changed. It is just less aggressive. You hold existing positions more carefully, but the structure has not broken. That is the distinction. A brief loss of the 11 is caution, not a signal to exit. What actually changes things is when the EMAs start crossing and tangling, when the 11 drops under the 21, when the 51 starts pushing above the 11, when the lines flatten and overlap instead of fanning out. That is when the trend template has broken down. On a BTC or ETH daily chart, this pattern corresponds to the market entering a choppy directionless phase or the early stages of a real breakdown. The right response is to reduce exposure or exit swing positions entirely. If you are holding something and the EMAs go from fanning upward to tangling together, that is your warning. The opposite picture is what you are looking for before entering any trade. All 3 EMAs fanning out upward, price sitting cleanly above all of them. That is the context you want. The second use case is asset selection, and this is where most people miss an opportunity. Most traders only think about indicators after they have already picked a coin. But you can use the EMA structure as a filter before you look at individual charts at all. The filter works like this. First, price must be above the 50 EMA. That removes anything in a breakdown or sideways structure immediately. Second, the 11 EMA must be above the 21 EMA. That confirms the short-term trend is strong and aligned. Third, the 21 EMA must be above the 50 EMA. That confirms the midterm structure is also healthy. Run these 3 conditions on a screener, and what comes back is a list of assets in a clean, confirmed uptrend. That is your starting pool. You are not looking at everything, only the coins that already meet all three conditions. From that filtered list, you then look for a specific chart structure. The setup you want is a prior uptrend, followed by a controlled pullback to one of the key EMA levels, followed by a tight range forming near that level. Not a crash, not a trend reversal, a pullback that finds support at the 11, 21, or 51 EMA, and then price consolidating into a narrow range right there. When the range contracts and price starts pushing back above it, that is your entry zone. You are not chasing the move, you are entering the resumption. One more thing on entries. Avoid any asset that is extended far above all three MAAs. If there is a large gap between current price and the EMA lines, and the EMAs themselves are spread far apart, that asset is in an exhaustion phase. Mean reversion, the tendency of price to return toward its average, will pull it back to close that gap before it continues higher. Do not try to enter at extension. Move to the next asset on your filtered list and wait for the overextended one to pull back first. Now, stop loss. This is straightforward. You use the nearest EMA as your stop level. If you entered on a pullback to the 11 EMA, your stop goes just below the 11. If the 21 was where price found support and you entered there, the 21 is your stop. For a swing trade, you want that stop within roughly 7% of your entry. Ideally tighter than that, under 4%. When the setup is correct and the entry is at the right EMA level, the stops tend to fall in that range naturally. If a setup requires more than 7% of the nearest EMA, the entry is too extended or the structure is not clean enough to trade. Here are the buy conditions to go through. One by one. Price is above all three EMAs, the 11 is above the 21 is above the 51, and all three are sloping upward. The asset has pulled back to the 11 or 21 EMA and held it. A tight range has formed near that EMA level. Price breaks above the high of that tight range on a strong candle. That is when you enter. Stop goes just below the nearest EMA. For the exit side, the conditions reverse. Once you are in a trade that has moved in your favor, you trail using the 11 and 21 EMA. As long as price is closing above those levels on the daily chart, you stay in. The moment you see a full candle close below the 21 EMA, not just a wick, but a body close, that is your exit signal. You take the trade-off. If the broader structure breaks down further, meaning price drops through the 51 and all three EMAs are now above price and sloping downward, that is a short environment. In that condition, you are waiting for the market to recover its EMA structure before looking for new long entries. There is one additional adjustment when price becomes very extended. If a coin you are holding moves 15 to 20% or more away from the 11 EMA, with a visible gap opening up between price and all three lines, it makes sense to take partial profits at that point. Not a full exit, just trimming. Let the asset pull back and close that gap. If the EMA structure holds during the pullback, you continue trailing what remains. You can also use the same three EMAs to read the broader crypto market context before entering anything. Pull up BTC on the daily chart. If all three EMAs are above price and pointing downward, the market is in a downtrend and your individual swing setups are going to fail at a much higher rate. In that environment, the right move is to reduce exposure and wait. When the BTC chart shows price above all three EMAs, with the lines rising and fanning apart, the market environment is favorable and your setups have the broader trend behind them. That context check takes about 5 seconds and it will keep you out of a lot of losing trades. The full process comes down to this. Filter your watch list by EMA structure, price above 50, 11 above 21, 21 above 51. From that filtered list, find the ones showing a pullback to a key EMA with a tight range forming. Enter the breakout of that range or the first strong close back above the EMA. Stop goes below the nearest EMA. Trail using the 11 and 21 and exit when a daily candle closes below the 21. 3 lines on a chart, and every step of the process is covered. Now, if you made it this far, there is something worth pairing with this. The EMA system tells you whether a trend is healthy and gives you a precise entry trigger. What it does not tell you is where you are in the larger move, whether the asset is early in a run or approaching the end of an impulse. There is a video on this channel that fills in that exact gap. It covers the Elliott Wave Advanced V3 indicator, which validates wave counts against all 3 cardinal rules before placing any label on your chart, so you always know the structural position of the move you are entering. The two approaches work directly together. EMAs give you the entry. Elliott Wave gives you the context behind it. That video is right here. Go watch it next.